Hello, everyone. Welcome to Real Estate Principles, Unit 3, Ownership of Real Property. You're going to see a lot of terms and key terms in here that will definitely be showing up on the state test. So make sure you have good notes and that you go over the overview and you understand some of these principles in here. All right, let's get started.
Learning objectives. When you have completed this unit, you will be able to accomplish the following. Identify the various estates in land, including freehold estates of ownership and leasehold estates of tenancy. Describe the difference between a reversion and a remainder. List the ways in which title to real estate may be taken by an individual. Distinguish the forms of concurrent ownership. Describe the attributes and ways of acquiring community property. List the forms of business ownership of real estate. Define a trust and describe how a trust can own real estate. Estates and land. In the previous unit, you learned that in California the term real property means the same thing as real estate. The terms are used interchangeably to refer to land, fixtures to land, anything incidental or appurtenant to land, and anything immovable by law. The ownership of property consists of a bundle of rights or interests in it. Rights of ownership include the power to possess, use, exclude others, and dispose of the property. An estate is an interest in property. All property that is not real property is personal property. Freehold estates. In medieval England, the freehold estate was the highest form of land ownership. The owner of a freehold estate and land could use the property in any way, without being subject to the demands of the overlord. Today's owner of real estate also enjoys a freehold estate, but there usually are some restraints on how the land may be used. A freehold estate can be held for an unlimited time, or the period of ownership may be limited in some way. Fee simple estate. The fee simple estate is what may be termed a present possessory interest. It carries the maximum bundle of rights. The owner of a fee simple estate has the right to use the property right now and for an indefinite period in the future. The highest, most complete form of ownership is a fee simple absolute. The owner has the right to transfer ownership of the estate by selling it or giving it away. A fee simple absolute estate can be lost if an unpaid mortgage on the property is foreclosed, or if the property is sold because of unpaid taxes. If the right of possession is restricted in some way, the ownership interest is a fee simple subject to a power of termination, which is also called a fee simple defeasible. A fee simple estate may be granted subject to a limitation on the use of the property or a condition that the property holder must or must not perform. The power of termination granted by the limitation or condition specified in the deed, the document conveying title to the owner, expires 30 years after the recording of the deed, unless it is extended for an additional 30 years by recording notice of the extension before termination of the prior 30-year term. A power of termination will not expire during the lifetime of the grantor if the grantor is a natural person and the grant was made without consideration to a governmental entity or a tax-exempt organization. With a fee simple estate subject to a condition subsequent, there is some action or activity that the fee simple owner must not perform. If the condition is broken, the former owner can retake possession of the property. Enforcement of a fee simple subject to a power of termination or condition subsequent is by filing a notice of that intention or bringing a civil action. The notice must be given or action brought within 5 years of the breach of the restriction, or the power of termination will expire. Example, a rancher gives a 1,000-acre parcel of rural land to the Church Youth Fellowship on the condition that there is no sale or manufacture of alcoholic beverages on the property. Years later, the rancher visits the property and is surprised to find a reception in progress and a no-host bar at which drinks are being purchased. What can the rancher do? The fellowship has broken the condition subsequent to its fee simple right of ownership. The rancher can file a notice of intent to re-enter the property and claim possession, or the rancher can bring a legal action against the group. Life estate. A life estate is an estate of ownership. The owner of a life estate has the right to possession and use of property, but the estate lasts only as long as the life of a person or person identified in the deed or will that creates the estate. Usually the measuring life is that of the holder of the life estate. If the right of possession returns to the original property owner when the life estate ends, the original owner has a reversion, as shown in the following figure. If the right of possession goes to a third person when the life estate ends, the third person has a remainder. The remainderman holds an estate in remainder during the existence of the life estate and a fee simple estate on termination of the life estate. Mortgage interest bolder of a life estate is called a life tenant because the life estate conveys the right of is considered the possession of the property. In turn, the life tenant must keep up the property and pay taxes. If responsibility of the die life tenant pays a debt, such as mortgage principal, which also benefits the reversioner or life tenant. Remainderman, the life tenant is entitled to reimbursement. The use of the life estate can be transferred by gift, lease, or sale, but the right of use and possession ends with the measuring life. Because there can be no guarantee that anyone will live to a certain age, the value of a life estate will be based on the life expectancy of the individual S against whose life the estate is measured. A special situation arises when the measuring life is that of someone other than the holder of the life estate. This is termed a life estate per autre vie for the life of another. The life tenant may die before the other person against whose life the estate is measured dies. In that case, the life tenant S interest passes to the life tenant's heirs and will last until the end of the measuring life. The reversioner or remainderman can give, sell, or lease that interest, but no right of possession will take effect until the termination of the life estate. Life estate. A widower died, leaving a life estate in his home to his sister, and the remainder to his only son. The sister had been living in an apartment and was very pleased to have the use of the house. The son, upset when he found out what his father had done, insisted on being allowed to live in the house, for it was really his. Does the son have that right? No. The deceased's sister, the life tenant, has the sole right of use and possession of the property while she lives. Leasehold estates. A leasehold estate is one of possession, but not ownership. It is a non-freehold less than freehold estate. A tenant is someone who leases rents property from a landlord, so the tenant S interest is called a leasehold or estate of tenancy. Instead of an ownership interest, the tenant has the right to use the property for the lease term. Exercise. Identify each of the following types of ownership interest in land. The resident of Blackacre has sole possession of the property until death. The Middle Falls School has sole possession of Whiteacre, on the condition that it is used for educational purposes. The town of Merry Meadows has a beautiful library building. The building is a former mansion that was donated to the town with the stipulation that it be used only as a library. What kind of estate does the town have? A renter has lived at 316 Iowa Street for 15 years on a month-to-month lease term. What kind of estate does the renter have in the residence on Iowa Street? By will, a residence in Palm Springs was left to N for the life of N's uncle. Upon the uncle's death, the home is to go to Q. What estate does N have? What estate does N have? What estate does Q have? What happens if N dies before the uncle does? Taking title to real estate. A conveyance of real estate is called a grant. The person conveying the property, the owner, is the grantor. The person receiving the property is the grantee. There will be many possible roles for the owner of real estate discussed throughout this book. A good rule of thumb to remember is a word that ends in or stands for the property owner. Title to real estate, its ownership can be taken by one person or by more than one person. When a conveyance of real estate is done correctly, title vests in is transferred to the grantee. Advising someone on how to take title is a legal question that may have tax and other consequences. Such advice should come from an attorney or CP, a certified public accountant. A real estate licensee is prohibited from giving legal advice. Individuals taking title to property should indicate their status as single, never married, married, registered domestic partner, unmarried, divorced, widow if the husband has died, or is widower if the wife has died. For example, title may be conveyed to Sarah Smith, a single woman, or John Jones and Robert Lopez, a married couple. Ownership and severalty. Ownership and severalty, also called separate ownership or sole ownership, is ownership by one person. The property owner, who can be an individual or a legal entity, such as a corporation or trust, is the only person to receive the benefits of ownership. The separate owner also is the only person responsible for the burdens of ownership, such as the payment of taxes. Concurrent ownership. Concurrent ownership is ownership by more than one person at the same time. There are 4 types of concurrent ownership. Tenancy in common. Joint tenancy. community property, tenancy in partnership, tenancy in common. A tenancy in common is created when it is specified by name. It also is created when more than one person takes title, they are not married to each other, and no other method of taking title is specified. Tenants in common may take title at different times and may own equal or unequal shares. If no distribution is specified, tenants in common are presumed to own equal shares. Tenants in common have what is called unity of possession, which means that each tenant has the right to possession of the property and cannot be excluded by the cotenants. Even if they own unequal shares in the property, each has the right to use all of it. If the property is rented, tenants in common share the rent according to their individual shares. Expenses of the property, such as taxes, also are shared. A tenant in common can give away, sell, or devise will her share of the property to someone else. The recipient receives the share of the tenant in common and full right of possession. A tenant in common may want to dissolve the shared ownership. This can be accomplished by agreement of all cotenants or, if there is a dispute, by a lawsuit known as a partition action. If it is possible to divide the property among the owners in equitable shares, the court will do so. Otherwise, the property will be sold. If a sale is ordered by the court, the proceeds of the sale will be distributed to the cotenants in the same shares as their ownership interests, less a proportionate part of any expenses owed. Example: A.S. and J are all owners of a fee simple estate in Paradise Acres, a mountain retreat, as tenants in common. Each has a 1/3 share of Paradise Acres. Gibbon Properties manages Paradise Acres. Who pays the management fee? Who gets the profits, if any? Each of the tenants in common is responsible for 1/3 of the management fee. Each will take 1/3 of the profits, if any, after the management fee and expenses are paid. Joint tenancy. A joint tenancy is a special form of co-ownership. It requires that all co-owners take title to the property at the same time by the same document. In addition, each must have an equal share of the property. These four unities of a joint tenancy, which can be remembered by the acronym TTIP, are as follows. T, unity of time, each takes title at the same time. T, unity of title, each receives title through the same deed. I, unity of interest, each owns an equal share. P, unity of possession, each has the right to use all of the property. If the joint tenancy is created properly, the joint tenants benefit from the right of survivorship. This means that when a cotenant dies, the survivors receive the deceased's share. If there are only two joint tenants, when one dies, the other becomes sole owner of the property. One of the most important features of a joint tenancy is that when ownership transfers by right of survivorship, whether to a sole surviving joint tenant or more than one surviving joint tenants, the property does not go through probate. As a result, however, a joint tenant cannot will name an heir to his share of the property. As long as the joint tenancy exists, the right of survivorship in the other joint tenant takes precedence. Example: 10 years ago, X and Y bought a house as joint tenants. Their deed did not include the words "with right of survivorship Y married T" and moved out of the house previously shared with X. Before X and Y could sell the house, as they had agreed, Y died unexpectedly. Who owns the house? X is sole owner of the house. X and Y had taken title as joint tenants. Because one of the characteristics of a joint tenancy in California is the right of survivorship, those words do not need to be written into the deed transferring title to the joint tenants. Even if Y had made a will leaving all of the property Y owned to T, the will would be ineffective as to Y's share of property held in joint tenancy. Joint tenancy. A joint tenant can terminate a joint tenancy, but the advice of an attorney should be sought to avoid problems. It is also possible for a joint tenant's share to be transferred to someone else while the joint tenant is still alive. Again, legal requirements must be followed. Such a transfer will sever the joint tenancy only as to that tenant, however. The new owner becomes a tenant in common. If there is only one other cotenant, the joint tenancy has been completely destroyed. If there is more than one cotenant, the joint tenancy remains in existence as to the other tenants. They still have the right of survivorship with respect to their interests. Any two people can be joint tenants, including a married couple and registered domestic partners discussed in the next section. Because spouses and registered domestic partners also can hold title to real estate as community property, they will want to consider the benefits of each form of ownership, preferably with the advice of an attorney. As pointed out earlier, A licensed real estate agent may not give advice on how to hold title. Community property. Community property is real or personal property acquired by a spouse during marriage or by a registered domestic partner as defined in Family Code Section 297. Each also may own separate non-community real or personal property, however, and acquire separate property. The rules described below for spouses apply also to registered domestic partners. A domestic partnership can be created by persons who are both of the same sex or of different sexes. A registered domestic partnership provides a couple with the same rights, protections, and benefits as a married couple in the state of California. Property that was a married person's separate property before marriage remains separate property after marriage. Property acquired during marriage may be either the separate property of one spouse or community property belonging to both spouses, depending on its source, the actions of the parties, and legal presumptions. Separate property is property acquired by gift or inheritance to one spouse, with the proceeds of other separate property, or as income from separate property. Spouses can agree to change community property to separate property. Most other property acquired during marriage is community property. Spouses are allowed to change community property to separate property by written agreement. The handling of money can change its character as separate property. If there is commingling of separate funds placed in the same account with community funds, they lose their status as separate property. If the ownership status of property is unclear, the courts will follow the legal presumption that real property in California acquired during marriage and personal property, wherever it is located, that is acquired during marriage, are community property. Community property cannot be sold, mortgaged, or leased for 1 year or longer without the agreement of both spouses. Both must sign all documents. A spouse can convey their interest in community property by will. The inheritor and the surviving spouse would then be tenants in common. If a spouse dies without a will, the surviving spouse is entitled to half of the community property as the survivor's own interest, and also receives the deceased spouse's half. Community property with right of survivorship. As of July 1st, 2001, spouses can take title to property as community property with right of survivorship. The document of transfer would have to stipulate that form of title, and both spouses would accept title in that form by writing on the face of the document a statement signed or initialed by both. With the right of survivorship, title passes to the surviving spouse without probate, just as if it were held in joint tenancy. Prior to the death of either spouse, the right of survivorship may be terminated in the same way that a joint tenancy may be severed. Civil Code 682.1. Example. N, who is married to R, signs a contract to sell the mountain cabin they own as community property. R is away on a business trip at the time the contract is drawn up and isn't interested in selling the cabin anyway. Can the buyer enforce the contract? No, because the cabin is community property. Both spouses must sign any instrument of sale. The concept of community property is a holdover from Spanish and Mexican rule. Only California and 7 other states still treat marital property in this way, and there are important differences in each state's law. In any move from state to state, the applicable laws should be determined to avoid conflict regarding property status. Quasi-community property. New California residents should be aware of the concept of quasi-community property. Quasi-community property is any California real estate acquired by an out-of-state married person that would have been considered community property if it had been acquired by a resident of California. And if any California real estate acquired in exchange for real or personal property located anywhere, when the California real estate would have been considered community property if it had been acquired by a California resident. Tenancy in partnership. The members of a partnership can own property for partnership purposes. A general partnership is established when 2 or more persons carry on a business for profit as co-owners. Property owned by the partnership is owned by the individual partners as a tenancy in partnership. All partners have the right to possession of partnership property for partnership purposes. Partnership property can be attached only by partnership creditors. When rights to partnership property are assigned, the rights of all partners must be assigned. The death of a partner will dissolve the partnership, unless there was a prior written agreement to continue the business. If a business is dissolved, its assets are sold, creditors are paid, and the remainder is distributed to the partners. If a partner dies and the business continues, that partner's right to possession of partnership property of the business goes to the surviving partner. The heirs of the deceased partner have no right to the property, although they are entitled to the deceased's share of the profits. The partners may agree in writing to a different distribution. All partners are liable for debts of the partnership. A partner's right in property owned by the partnership cannot be community property. For some purposes, however, a partner's interest in the partnership itself is treated as community property. For tax purposes, all partnership income is distributed to the partners, who report that income individually. An important feature of a partnership is that each partner is liable for partnership debts. For that reason alone, the decision to form a partnership requires careful consideration. Example: H is a partner in Accounting Associates. The partnership leases office space in 4 buildings. H needs storage space for some furniture H is donating to a charity. May H store the furniture in the partnership's office? No. As a partner, H may not use partnership property for personal purposes. Exercise: what form of ownership does each of the following people have in the property described? 2 siblings own a farm and have a right of survivorship. 2 people are married to each other and own a house together. No form of ownership was specified in their deed, as the spouses have not yet consulted an attorney. 2 single people bought a 3-story Victorian home in Sacramento. No form of ownership was specified. An individual is a partner in real estate consultants which owns a shopping center. A married person inherited a cattle ranch from a friend. The married individual is the friend's sole heir. Business ownership of real estate. Other types of business also can acquire, use, and sell real estate. This section discusses the following: sole proprietorship, corporation, general partnership, limited partnership, limited liability company, trust, sole proprietorship. The sole proprietorship is the simplest form of business ownership because it has only one owner. The sole proprietor conducts business in his own name or under a trade name, reports business income on his individual income tax return, and is responsible for the business's debts. The sole proprietor may or may not have employees, such as personal assistants. The corporation. Every state has specific laws regulating the formation, operation, and dissolution of corporations. The owners of a corporation are called shareholders. The corporation is a separate, legally recognized entity apart from owners' shareholders. It must be chartered by a state. It acts through its board of directors and officers. It may own, lease, and convey real property and zero limits liability of officers, directors, and shareholders. A corporation could be formed for a nonprofit motive. A nonprofit corporation is owned by members rather than shareholders. It can own, lease, and convey real estate. Corporations are called domestic corporations by the state in which they are chartered created. Corporations created in any other location are called foreign corporations. In California, for instance, corporations chartered by any other state are considered foreign corporations in their dealings in California. Liability. A major benefit of doing business as a corporation is that individual officers, directors, and shareholders are usually not held personally accountable for corporate decisions and corporate debts. Increasingly, legislation such as the federal Sarbanes-Oxley Act of 2002, also known as the Public Company Accounting Reform and Investor Protection Act of 2002, has imposed a greater level of accountability on officers and directors of public companies. Corporation. One disadvantage of a corporation is that profits are taxed twice. The corporation pays taxes on income, and income is taxed again when it is distributed to shareholders in the form of dividends. Federal tax law provides an alternative method of taxation to corporations with 100 or fewer shareholders. If the corporation is formed under the requirements of Subchapter S of the Internal Revenue Code, income is allowed to flow directly to shareholders, avoiding double taxation. In an S corporation, all shareholders must be individuals rather than other corporations. To be treated as an S corporation, shareholders must file Form 2553 with the IRS. If they do nothing, they will be taxed as a C corporation under Subchapter C and be subject to the double taxation mentioned above. To qualify as an S corporation, the corporation must be a domestic U.S. corporation with only one class of stock and no more than 100 shareholders, all of whom consent in writing to filing as an S corporation. The shareholders of an S corporation can be individuals, estates, exempt organizations, or certain trusts, but cannot be non-resident aliens. For complete information about filing as an S corporation, consult your tax advisor and the instructions for Form 2553 that can be found at the website of the Internal Revenue Service, www.irs.gov. Partnership. A partnership is an association of two or more persons to carry on a business as co-owners for profit. In a general partnership, each of the partners by definition has authority to act on behalf of the partnership, and each is liable for the debts of the partnership. Limited partnership. To avoid the unlimited liability of being a general partner, an investor can take part in a limited partnership. A limited partnership can be created only in compliance with state law. In California, this includes filing certain information with the Secretary of State. The California Limited Partnership must have one or more general partners who run the business and have unlimited liability for partnership obligations. Other investors can join as limited partners, and their liability will be no more than the amount they have invested in the partnership. By law, limited partners can take no part in the management of the partnership. If they do so, they will be considered general partners and will lose their limited liability. Real estate syndicate. A real estate syndicate can take the form of a corporation, general partnership, or other entity, but is usually formed as a limited partnership. A real estate syndicate could also take the form of a real estate investment trust REIT, which is discussed on the next page. In California, real estate syndicates are popular methods of investment for both corporations and individuals. A syndicate of 100 or more participants must be approved by the Department of Business Oversight before syndicated interests may be offered for sale. Strict rules and regulations must be followed. Taxes and fees are higher for an LLC than for a partnership, limited liability company. Almost all states permit property ownership by a limited liability company LLC. Although each state's law is unique, an LLC typically provides the single-level tax benefit of a partnership with a flexible organizational structure. In California, an LLC is created by filing a one-page form with the Secretary of State. LLC members are not required to have a written operating agreement setting out their rights and responsibilities, although one is advisable. LLC members may adopt corporate formalities such as resolutions and annual meetings, but are not required to do so. Unlike an S corporation, an LLC places no restriction on the number of shareholders who take part and who they are. The LLC provides something closer to the limited liability for corporate shareholders than the greater protection afforded to limited partners. Unlike limited partners, however, members of an LLC can take part in the running of the organization without incurring personal liability for business obligations. This freedom from liability does have a cost. In California, an LLC incurs higher taxes and fees than either a general or limited partnership. Information available on the web. The Secretary of State Business Service Center website at www.sos.ca.gov/business provides information on corporations, limited liability companies, limited liability partnerships, general partnerships, and other entities, including lists of officers and directors. Trust. Using a trust to hold title is a way to keep the true owner's identity hidden. A trust can be a form of property ownership. Title to property is conveyed by the trustor, the property owner, to the trustee. Title is held by the trustee on behalf of a beneficiary who controls the property held in trust. The trustee's powers generally are defined by the document establishing the trust. If the trustor fails to define the trustee's powers, the law of the state in which the trust is created is followed. A trust can last for a short or relatively long time, depending on the trustor's intent. Trusts often are created by the terms of a will, a testamentary trust to care for the decedent's children until they reach adulthood. Real Estate Investment Trust. The Real Estate Investment Trust REIT holds various forms of real estate or mortgages for the benefit of investors who own shares of the trust. REIT shares may be publicly traded. A REIT gives smaller investors the opportunity to own part of a portfolio of income-producing real estate and real estate-backed promissory notes. Individual investors, rather than the REIT, pay the taxes on the majority of the income received by the REIT when they pay their personal income taxes. REITs. In California, a real estate investment trust REIT is regulated by the Commissioner of Corporations. It must comply with federal and state tax law. It must be owned by at least 100 different investors. Cannot have any five investors own more than 50% of the trust, must receive at least 95% of its income from investments, and must receive at least 75% of its investment income from real estate. Living trust. The living trust or inter vivos trust is an increasingly popular form of property ownership. A living trust can be used to hold title to property during the lifetime of the trustor, who is also named as the trustee of the trust. When the trustor dies or becomes incapacitated, control of the property held in trust passes to a successor trustee named in the trust document. In this way, property ultimately can be transferred to the beneficiaries identified in the trust without going through an expensive probate process. A living trust also can be created by a married couple, with the property held in trust going to the successor trustee on the death of the second spouse. Properly drafted, a living trust can be an effective estate planning tool that provides the easiest and quickest way to transfer property at death. Exercise. What form of ownership does each example below illustrate? The Spice Company owns a processing plant and leases dock space for its shipments. The company is doing very well and it paid an excellent dividend to shareholders last year. A real estate broker owns Worldwide Real Estate and is the only owner of Worldwide. Company income is reported on the broker's personal tax return. Mountain Properties is a real estate syndicate of 127 investors. Only 5 members of the syndicate are allowed to participate in investment decisions. A decedent's farm was willed to the decedent's cousin, but the cousin will not receive title to the farm until reaching the age of 25. In the meantime, Drover's Bank will manage and hold title to the property.
All right, everyone. We're almost done with this unit. Good job. I know this was a lot of difficult key terms and new things that we're learning. So, real estate and real property are synonymous. The highest form of ownership in real property, remember, is a fee simple absolute, right? You absolutely own that property. It's also possible to own a life estate to enjoy property for the time measured by one's own or another person's life. A reversion or remainder is the right to possess a property after the death of the holder of a life estate. A fee simple subject to a power of termination or condition subsequent may be lost on breach of a limitation or restriction. Okay. A conveyance of real estate takes place by a grant from the grantor, right? Super important. Grantor is the owner to the grantee, right? Person they're passing that property to. Property owned by only one individual is separate property. Both real property and personal property can be separate property. Property acquired during marriage or by a registered domestic partner by a gift, inheritance, or with the income or proceeds of separate property is separate property unless commingling, right? Remember, commingling is putting those funds together in that same account. So remember, keep it separate. If you put the money together, it's commingled and it might be considered joint property. Most of the other property acquired by a spouse or registered domestic partner is community property. Two or more persons may have concurrent ownership of real estate as tenants in common, joint tenants with the right of survivorship, or tenants in partnership. Remember, joint tenants, right? You take title as joint tenants, and if somebody dies, the property automatically goes to the person who lives, right? So, joint tenants, someone passes away, it goes automatically to the other person. Tenants in common share utility of possession, which means that each tenant has the right to use the entire property. Joint tenants share 4 unities of time, title, interest, and possession. A partition action can be brought by a continent who wants to have the entire property divided or sold. Great job, everyone. On to the next unit. Thank you.